everybody that and I'm going to start the introductions and we're going to start. So again, thank you very much everybody for coming. We usually do the Zoom in Hebrew, but we're going to do it today in English.
אפשר בעברית גם, אם אתה רוצה.
I think we're going to...
קשה להסביר cost segregation and depreciation.
First of all, we invited non-Hebrew speaking as well to this Zoom because I knew it's you. So usually we send it in Hebrew, but since you saw, I posted it in English in different places. So if somebody comes and his English is not as fluent as ours. And the second is, of course, explaining cost segregation in Hebrew, I think going to be a funny challenge to do. So we're going to pass on it, but I'm going to close my mouth and I'm going to let you talking. And if anybody have a question, feel free to unmute yourself, ask the question. If somebody doesn't feel comfortable with the English, feel free to, on the chat, to send me the question in Hebrew in the chat. And either you're not going to pick it up or I'm going to pick it up. We're going to translate it and we'll take it from there.
Okay.
Yonah, all yours. Thank you.
Thank you. Thank you. Thank you, Tal. Pleasure to be here. This is great. I have not yet tried to explain cost segregation in Hebrew. Actually, I have tried to, and I just find it too difficult. So I'm glad we're going to stick with the English. I did a Yiddish once, but that was also a little difficult. I would love for everyone to open up the chat. I see most people have their cameras off. It means maybe you're at work or something and multitasking here, and that's totally fine. But if you can open up the chat, I just want to make sure that we are paying attention for those who are joining us live, and just write in the chat a couple things. One, I just want to know if you've ever heard of cost segregation before. So if you've heard of cost segregation before, just write the number. If this is the first time, let's do it like this. If this is the first time you've ever heard of cost segregation, write the number 1. Okay, just write number 1 in the chat. If it's the second, if you've heard of this before but don't really understand it so well, write the number 2. Just want to see if anyone's paying attention here. So I'm looking for either 1 or 2. First, the first time you ever heard of it, that's going to be number 1. 2, if you've heard of it but don't really understand it, and then 3, if you actually know really well what it is and perhaps have used it yourself as a tax strategy. So good. I see we have a good mix of people here. We got 1s, 2s, and 3s. And then, of course, number 4, if you're the real cost segregation expert and you want to just take my place here, you can write a 4. All right. So we got I see mostly 1s and 2s. There are a few 3s, so that's good to see. There's always more to learn. And I'm excited to just kind of share the knowledge, share the information. We're going to keep it simple. And we will get into more complicated questions, I think, later on. And if you do have questions, as Tal mentioned, please use this chat. You all now know where it is. You've all used it. Please use it, open it up, and ask those questions. And we'll make sure to get to every single one. If not live here, then we'll make sure to follow up with those as well afterwards. So just to keep it simple, without any background or anything like that, cost segregation is a tax strategy and it's called depreciation. So if you guys, those of you who wrote number 1, and this is the first time hearing of cost segregation, have you ever heard of depreciation? How about yes or no? Got some familiar faces here. Good to see some people. Okay, so Idan's heard of depreciation before, knows what depreciation. So cost segregation is really just depreciation. That's all it is. It's just an advanced form of depreciation. So depreciation, right? Depreciation is a tax deduction, and not to be confused with the actual definition of depreciation, which is that things go down in value as time goes on. We're not going to get confused by that definition because when we're talking about taxes and depreciation, it's a borrowed term. Okay, it's a shem mushal, right? Borrowed term. We're just using it to take this tax deduction. When you buy a rental property or a business property, anything besides your personal residence, you're able to take this tax deduction called depreciation, and it's based on the principle that things go down in value as time goes on. However, your property is certainly not going down in value, and it's not intrinsic to the actual property, meaning it does not begin when the property was built or when it was, first rented out. It begins when you, the new owner, buys a property. So you, new owner, buy a property for, let's say, $1 million. You're able to now take a tax write-off starting the day you buy it over a 27.5 year period, you're able to deduct that entire amount of your purchase price minus a certain amount for land, which doesn't depreciate. So that's called depreciation. You're able to take a tax deduction, an income tax write-off of your entire value of the property based on when you bought it and based on when your purchase price was. Okay. So that's depreciation. Everyone understand that clear? Yes, see some shaking heads. Okay, everyone clear on depreciation. And again, don't be confused by the name because it's just a borrowed term. And again, it doesn't actually mean it's going down in value. When you buy a new property, even if it has been, built in 1952, it doesn't matter. It now starts that 27.5 years or 39 years for commercial properties starts today when you buy it. Now, depreciation. Yeah, go ahead, Tom.
I want to stop you 1 second because I know the crowd a little bit, so I want to add something just to make sure.
Please.
Taxes in Israel and in the United States work a little bit different.
Right.
And the government in the United States, the IRS, allow you to depreciate the full amount that you purchase a property. And if it's a commercial property, over 27.5 years. So you take, let's say, $1 million, you split the amount over 27.5 years, which is, I think, $29,000 a year. And basically what you get is automatically, you get a $29,000 a year tax deduction. It doesn't mean that it goes down in value. It means for tax purposes only, you get a $29,000 deduction. And what Yonah is explaining is how do we accelerate this? And so it's the same strategy, but on steroids.
Right, exactly.
Oh, yeah.
Now, I'm glad you pointed that out because yes, the tax system is different in Israel and real estate. Yes, there is something called pchat, like a deduction. I'm not exactly sure how it works. I'm not really an expert on the Israeli tax laws. However, what we're talking about today is going to be specific to the U.S. tax code and specifically rental properties in the US, although I should just mention here, parenthetically, it's not limited to rental properties in the US. If you're a US taxpayer and own properties outside the US, even in Israel, you can take depreciation deductions on those properties as well. Just parenthetically, we're not going to get too much into that. But again, yeah, we're focusing on the US and all these rules are going to apply to the US tax code. So cost segregation, as Tal mentioned, is like depreciation on steroids. What does that mean? The name cost segregation, okay? Cost means the purchase price, the cost that you bought the property for, and segregate means to split it up into different groups or different categories. So instead of depreciating or taking this tax deduction an equal amount, like the $29,000 a year, every year an equal amount over 27.5 year period, you're able to break down the property from an engineering perspective and show how different components of the property depreciate at different schedules on different time periods. So really it's called component depreciation. So if you think about cost segregation, really it's called component depreciation. We're taking the tax deduction of individual components on their respective tax lives. So for example, certain things the IRS says depreciate over a 5-year period. And so there's a large category of things inside the property that are non-structural, like furniture or equipment or even shelving, lighting, window treatments, all kinds of things that are non-structural. And really, only the structure is supposed to depreciate on that 27.5 or 39-year schedule. So if you think about, you buy a building, you buy a house, you buy a property, it doesn't matter what it is. This can be done on residential, commercial, any type of property. The main value is always going to be in the structure, okay? The roof, walls, doors, windows, right? Infrastructure, foundation, all that stuff, right? That's where the main value is going to be. However, there is value also in the components within the property. Like I mentioned, carpeting or flooring, cabinets, window treatments, equipment, furniture, all that stuff is considered non-structural. And the IRS says it actually depreciates on a 5-year schedule, meaning you can take, if you identify and establish what the value of those components are, you can take them as a tax deduction over a faster period, accelerate the depreciation deductions. That's called cost segregation. Now, it's really easy to do this when you're doing a new construction. Okay, think about it. If you're building a new property, new construction, you know exactly what the cost of every individual component is, right? You have an itemized list. you're paying $10,000 for the windows and another $10,000 for the carpeting and flooring and another whatever, $5,000 for the furniture, etc. You know exactly the cost. However, and so this can be done very easily on a new construction. What we're doing really in the challenge of the cost segregation is we're doing this on an existing property. You buy a property that was built, who knows, 30 years ago, and you're buying it new for $1 million, even though the cost to build it, 30 years ago was only $10,000 or whatever. But now we have to take that purchase price and break that down into its components and show how all of those individual components and reverse engineer and add everything back up to equal that purchase price. Okay, so simply put, just to recap here, what we're doing is identifying components that depreciate faster, taking those tax deductions of those components at a faster rate, and creating a depreciation schedule, meaning a tax document that shows how much you can take, and we're accelerating that depreciation to the faster years. So usually for most types of properties, we're going to be looking at about 15 to 30% of the property. So kind of sweet spot 20-25% of most types of properties, multifamily especially, that you can take as a faster depreciation write-off over a 5-year period. There's also another category called land improvements that depreciate over a 15-year period. Okay, so make sure you guys put your questions in there in the chat if you have any. I see some eyes glazing over, but that's okay. What we're going to do here is just break this down, understand it, and walk through an example right now of how this would actually work on, let's just take a multifamily property. But before I do that, I would love to see, for those of you who are real estate investors or own real estate, if you wouldn't mind in the chat, just write what type of property you guys invest in, right? Single family or multifamily or self-storage or short-term rental, or not yet, or on the way, something like that. Just let me know you're paying attention here. Write something in the chat, what types of properties that you personally own or invest in. Is it maybe passive? You can write passive. You can write mobile home parks. You can write whatever you want to write there. We got some retail. We got some new construction, single family, fix and flip. Okay, a lot of different things, multifamily, so many different types of real estate. And we can do cost segregation. We can take depreciation on pretty much everything. Okay, so a lot is on the way. Multifamily, mobile home parks, awesome. There's a lot, and mobile home parks, I should talk about that in a minute, about how it's a little bit different when it comes to cost segregation. Land, as I mentioned before, does not depreciate. Okay, land does not depreciate, meaning if you buy a piece of land, just raw land, you cannot take that depreciation deduction. Now, the deduction that we're talking about here is a really big incentive, because by reducing your taxable income, you can have more cash flow and you can just use that to reinvest. How that's going to apply is going to be a little bit different depending on who you are and what your status is in terms of real estate professional. I'll talk about that in a second as well. But simply put, creating the whole point of cost segregation is, instead of just having a small deduction, by creating a larger tax deduction, you can reduce your taxable income ultimately to zero and hopefully pay zero taxes and just use that money that you would have paid taxes to reinvest. And that's really how the wealthy do this, and especially people who are considered full-time real estate professionals. And that's a good segue to talk about real estate professional status here for a second, because this is, unfortunately, it's not equal to everyone. These deductions are usually just used to offset your rental income. Okay, so active earned income, W-2 income, is treated differently than your Schedule E, what's called your rental property or your real estate income. And it's really important to understand this, because the depreciation deductions we're talking about today, and all the time we're talking about cost segregation, it's really just depreciation. So I'm using the words interchangeably. Okay, depreciation, cost segregation, it's all one and the same. What we're doing is just, but with cost segregation, we're able to create or front load or accelerate, whatever word you want to use, more deductions in the earlier years. But essentially, it's just those depreciation deductions. So the more of those deductions you have, the more you can actually, or the less you'll pay in taxes, the more you can reinvest. However, as I just mentioned, your active income, your W-2 income, is treated differently than your rental income. Meaning, if you have, let's just give it an example. Let's say you buy a property for $1 million. Okay, $1 million property, typically without cost segregation, your normal depreciation deduction would be about $30,000 a year. just round numbers, okay? So your $1 million property, if it's making any more than $30,000 in net profit, that means you're going to be taxed on that income. However, with cost segregation, you can typically take, let's say, 20% of that in the first few years, which means you'll be doubling your deduction, which over the first 5 years, let's say. So if you're making any more than $60,000 of income from that property, then you're going to be taxed on that. But if you're making up to $60,000 on that $1 million property, you won't pay any taxes on it during the first 5 years. Okay. However, using something called bonus depreciation, which is an option once you've done a cost segregation study, and I know I'm throwing out a lot of terms here, maybe a little fast. If you do have questions, please don't hesitate to stop me here. But if you do something called bonus depreciation, and you can take that full $200,000, that 20%, again, of your $1 million property, you can take that in the first year. That means instead of a $30,000 or $60,000 deduction, in the first year, you can actually get a $200,000 tax deduction, right? However, what happens with those deductions? So if you are not a real estate professional, meaning your full-time job is not in the real estate business, and you have a job and you also own rental properties, you also invest in real estate on the side, the rental income is the only place where that depreciation deduction can hit and can help to reduce. So if you made $50,000 from your rental income and you have a $200,000 deduction, what we're doing is reducing that to zero. You're not going to pay any taxes on the rental income for your Schedule E. However, the extra $150,000 will just create what's called a passive loss. That will just carry forward. You can use it next year, but you cannot use that against your W-2 income. Okay, you can't use that. It's going to be limited just to that bucket unless you are a real estate professional. If you are a real estate professional, meaning that you or your spouse, only one of you needs to have this status, that you or your spouse spend your full-time job materially participating in real estate, meaning renting it, managing, brokering, right? Construction, anything you're involved. So if you're doing fix and flips and that's your full-time thing, guess what? You can use the depreciation from rental properties to offset your income from the fix and flips, okay? Unless you have another full-time job. If you have a W-2, you cannot simultaneously be a real estate professional. But again, once you do have the status of real estate professional, then that extra deductions, those $150,000 in our example, can now be used to offset your W-2 income or your active income. And so this is really, yeah, go ahead, Tal.
I'm going to stop you. You're running very fast, which is good. I like fast, but
I talk fast.
Yeah, but no, that's absolutely fine. But I have a couple of questions for you in behalf of everybody, I think. But
sure.
Before that, I'm going to ask a couple of questions to the guys. We went very fast. Anybody, if somebody don't understand or lose something in translation here, please stop us. The purpose is for us to understand. And if we need to repeat it, it's totally fine. So there is no reason to lose anything. We have time and we can go. So again, if somebody want to ask a question or want to ask us to repeat something, feel free to let us know.
I don't have a specific question, but I'd love a recap, like a summary of what we went through so far.
Yeah, sure. Absolutely. Yeah, and I know, excuse me, I do tend to talk a little fast, and some of these terms and concepts may not be familiar to everyone, so it's totally fine. But yeah, happy to recap and just kind of keep going. If you do have questions, I see Cheryl did ask one question in the chat there. We'll get to that in a minute. But just to recap, depreciation is a tax deduction that you're able to take when you buy a rental property. Sorry about that. However, there is a method called cost segregation that allows you to identify components of the property that actually depreciate faster, allowing you to take tax deductions of those things faster. Yeah, go ahead.
Let me help you here, Yonah.
You want
Daniel, and everybody, by the way, if we're missing here, you need to understand the way that the IRS look at real estate is not as, okay, this is a building, whatever it is inside is a one thing and that's it. So different components of the real estate by law can be depreciated differently. We're talking about time. How fast can we depreciate the full value of that items? So the building itself, the brick, is a one thing. The boiler is totally different story. The carpets is different story. So for example, I think Yonah used carpets. I'm going to use carpet. I like that to depreciate my carpets. But so carpets can be depreciated over 5 years. So let's say you have $1 million in carpet, you can depreciate $200,000 a year for 5 years. But the building worth $1 million, you need to depreciate over 27.5 years, which is about $30,000 a year. So what they do in cost segregation is they take different components of the building and say, okay, what is the tax law in relate to that? That 5 years, this is 27.5 years. And now they're putting tax deduction price, can we say tax deduction price on each item separately,
Right.
in order to come up with your deduction for that specific year, usually for the first 5.
Right. Right, exactly. And that's all we're doing. We're just following the tax code, and the tax code, the law defines how different property or different assets within a property depreciate on different schedules. So instead of taking a lump sum equal amount over 27.5 years, we're able to take certain amounts over the first 5 years, right? Certain things over a 15-year period and certain things over those faster schedules. So essentially what we're doing is we are front loading. Imagine you have this pool of potential deductions, right? That you could take equally a little bit every single year. What we can do is actually pull out some of those deductions so you can take them up front in the first few years. That's essentially how cost segregation works. It is an engineering study of the property, similar to like an appraisal, where we'll have an engineer come in and make an actual recording, an identification of all the things. Say, oh, you have, I'm looking just, you have shelves there, right? How much shelves, how much lighting, how many furniture, how much, carpeting, all these things, what the amount is, and then what the value of those components are within the whole property. And then once you do that, you can take a tax deduction of those amounts at the faster rate. Okay.
So, Yonah, can I ask you a question?
Yes, please, Eliran.
So you said something about being a pro and not being a pro. So the pro can actually get like the depreciation for the basically what you mean the capital gain, right?
So you're asking two different things here, right? There's the real estate professional status, which allows you to use those deductions against your active income, right? And then there's capital gain, which is what happens when you sell a property. You're going to have a capital gain. Those losses can also be used, right, against the capital gain. So two different things there, but yeah.
Okay, so what happened with if we structure a deal that is partly GP and partly LPs, which are not professional? So the GP can depreciate all capital gain and active income, but what's going on with the LP side?
So everyone will receive, if you have whatever structure you have, doesn't matter, right, how you structure a deal, if everyone owns a certain portion of the property, okay, they own a certain equity of the property, they're going to get, according to their percentage of ownership, that amount of depreciation. What they can do with that and how they can use that, on their taxes is going to differ between different people. Doesn't matter if you're an LP, doesn't matter if you're a GP. It matters more than anything if you are a full-time real estate investor, real estate professional. So if you are not, if you're just a passive investor, a limited partner, LP, you are going to be limited just to use those deductions against your rental income or whatever investment income you have. If you have, 20 different, rentals or 20 different real estate investments, that's all going to be lumped together. Okay, so it's all in one bucket. So you may be able to take depreciation from one property to offset the gains or the income from all your other properties or other investments as well, but you will not be able to use that against any other income. So those deductions are going to be limited to that space, that bucket.
So their deduction for the LP is just limited for the rental income, so they cannot deduct it from other capital gain that they had from other properties.
If they are not professional,
they can.
They can be. Eliran, they can be a LP and a professional. Let's say I put money.
No, obviously, if they are not professional, yeah.
Yeah. So yeah, they can be an LP, but I just want to clarify one thing there. Capital gains from rental properties is also considered, right, those passive gains like passive income, and can be used, the depreciation, to offset that. So let's say you sold a property and you had a capital gain and you have, use cost segregation, get a large depreciation deduction. You can use those deductions to offset that capital gain. Even if you're not a real estate professional, it's all treated together as well.
Thank you.
Okay. Let me talk a little bit about mobile home parks, as I did notice a couple of people invested in, we have Al here in the chat in mobile home parks and some other people. Mobile home parks are unique, a little bit different because yes, you're buying the land and land does not depreciate, but what you're also buying is the land improvements. And one of the other categories of depreciation is land improvements, meaning anything that's on top of the land, like concrete or pavement, right? Landscaping, fencing, anything, even signage or things like that, all depreciate on a 15-year schedule. So it's accelerated as well. And anything that is accelerated to a faster 5, 7, 15-year schedule, you can take as what's called bonus depreciation, meaning to take that full amount in the first year. Now, this is really, really exciting when it comes to mobile home parks because, yes, you may not be buying much at all. You're just buying land, but you're also buying the land improvements, the concrete pads under each home. You may not even own the homes themselves. Oftentimes, the tenants own their own homes. In mobile home parks, we're seeing, between 50 to 80% of the value of the purchase can be in the land improvements and the faster depreciation. So if you take our example of our $1 million property that we talked about before, and you take 20% for a single family or multifamily property, and you can take that $200,000 in the first year or over a first 5-year period, when it comes to mobile home parks, you can literally take $500,000 to $800,000 in every property is going to be different. I'm just kind of using a general number there, but you can take, that amount. So 50 to 80% of the purchase price, you can literally take as a faster deduction. So mobile home parks are kind of in a different category when it comes to, the amount of bonus depreciation that you can take up front. And let's get to some other questions here, guys. Keep putting in the chat there. I know Cheryl asked, what does it cost to do a cost segregation study? It's not dependent on the purchase price and it's not dependent on the amount of tax savings. So we don't charge like a percentage of your savings. It's just a flat fee. So for example, for single families, we charge somewhere between around $3,000 or so, and then it goes up from there. So multifamily maybe up to $4,000 or $5,000, not much more than that. So it's a pretty inexpensive thing, especially when you get into bigger properties. It doesn't matter if you bought a property for $1 million or $50 million, the cost of the cost segregation study is going to be pretty much the same if the amount of work on the property is going to be the same. So really important. Alone asked over here, I basically have to tell my CPA to work this way. Most CPAs know this. So good question. Alone, unfortunately, most CPAs don't know this. And you'd be surprised, even though this is taken directly from the tax code. This is, nothing outside of that. It's not some like weird loophole. This is actually the way the IRS wants you to depreciate your property by breaking it down and showing how everything depreciates on its own separate schedule. However, since this needs to be done by an engineer and someone with experience in the construction engineering, there are cost segregation companies out there. Like my company is called Madison Specs. We're the largest national company in the US doing this. We do about 5,000 of these a year. But CPAs, unless they're a large, huge CPA company, they won't have engineers in-house. And so they're going to need to refer you to a third-party company to do this. And many CPAs, if they're not focused on real estate, they may not even know about this. And so it is important, if you do own real estate, to actually have the conversation with your CPA to see if they do understand this and to see if this is something that they can, that they're willing to do. Or, once you have a cost segregation company do the study, can they apply what the findings are? And it's pretty basically just copy and paste. So if they can do a copy and paste, that's good enough, but they should be able to understand it.
It's about learning what to do copy and paste too.
Right, exactly. No, I think the important thing is have the conversation with your CPA, because if they have no idea what this is, it may be time. If you're focused on real estate and trying to use real estate to grow wealth and to get free from your job or whatever it is, everyone has different goals. You want to make sure you have a CPA that understands that.
Mm-hmm. I have a question.
Go ahead.
So when you're talking about depreciation, but there's also always a limit for how much a property can or anything can be depreciated. You can't get to a point that, that land or your property is worth nothing. So you have to have a limit of depreciation. I think that it's a little bit different than, for example, in other businesses that depreciated after a certain amount of time, the equipment you have or the improvement you have worth nothing. And then you can just completely wash it off. So where is the limit of that?
So, I mean, there's no real limit. The limit is based on the lifespan of the property. So we said 27 and a half years, right? Is the lifespan of residential properties, 39 years. But what we're doing is, especially if the goal is to continue scaling, right, and to buy more properties one year after the other, this is one of the strategies to use to just pull from those potential deductions as much as possible up front, right? Yes, you're absolutely right. If you buy a piece of equipment, you can depreciate that. You can take that entire value as a write-off. And this year, you'll get that write-off. Next year, you won't have anything to write off unless you buy new equipment. But with depreciation, you're still going to have the structural components. Like I said, usually the majority, 70 to 80% of the property is still going to be in the structural components and are going to depreciate over time as well. So all we're doing is pulling from those deductions that can depreciate faster, the certain components like carpeting and, flooring and cabinets and furniture and fixtures and all those things that depreciate faster. All we're doing is taking the value of those things and depreciating them, taking those tax deductions at that faster rate. After the 5 years is up, you will still have the structural components. You're going to get depreciation every year. However, if you want to continue scaling this, it's better to probably, buy a new property every year at least, so that you can basically do this and continue to grow your capital tax-free.
So basically, after 27 and a half years, your property is 100% depreciated.
Yeah, exactly. But again, it's relative to you as the owner. When you buy a new property, that schedule starts over.
Okay.
On the new property.
On the new, so
for the new owner.
It starts when you buy it, not if you own a property that's like over 30 years, because I have properties that's way over 100 years old.
Correct. It will start for you. Your 27 and a half years begins when you buy a property, right? So it's relative to you as the owner. Doesn't matter when the property was built.
And it doesn't reset when you refinance or anything like that. It's just
no, unfortunately,
actually claim ownership.
Correct. Yeah. Does not reset when you refinance. So it looks like Eliran had Idan, I see in the chat over here, had another question. Can I offset rental depreciation losses with new construction? I'm not sure I fully understand the question, but if you are building a new construction property and you are holding it to rent, then yes, you can use depreciation to from that new construction rental property. You cannot take depreciation from a fix and flip, right? Because you're just selling it. It's like a transaction. Again, depreciation is only a deduction for rental property. So if you are a fix and flipper, you want to make sure to also have rental properties so that you can use the depreciation deductions. All right.
There is no depreciation in flips, guys.
There's not enough time for it to depreciate it.
I'm saying that there is no, yeah. Also, tax code wise, when you do flips, when you buy something in the purpose of selling it, it's considered to be like trading in real estate, not investing in real estate, versus holding it in a long period. Then you are an investor. So it's a different. We're talking about different tax code a little bit.
Right.
And we are looking on a long-term rental, which is. You guys know me, so you know that I prefer it, but it also gives you so much more from tax perspective. We always, when we do our models, we're looking at returns, but we look at them before taxes.
Mm-hmm.
And when you look at them after taxes, that's a totally different story, because for rental, there is so many tax. So at the end of the day, you leave in your pocket much more money than when you're doing flips, because maybe it looks nice on the financial model because you don't include taxes, but when you include taxes, totally different story. So flips, there is no depreciation.
Right, exactly. So, Eliran asked the question: is it true that it's valid up to 2024 for now? So let me get to this. I just want to clarify what Eliran means by this statement. So cost segregation has been around for decades, and it's going to continue to be around, this strategy of depreciating your property on these different schedules. However, there was something I mentioned before called bonus depreciation, which allows you, once you've done a cost segregation study, it allows you to take all of those accelerated deductions upfront in the first year, okay, which is a huge amount. It's something that's really a game changer, allows you to take these huge tax losses. However, this year, 2022, is the last year that you can claim this 100% bonus depreciation. Okay, so next year it's going to start going down by 20% each year, meaning next year is going to be 80% bonus. And I think that's what Eliran was referring to in the question. So just to clarify that, this year is the last year for any property bought in 2022. You can claim 100% bonus depreciation, meaning take that full amount of accelerated depreciation deductions in the first year. So let's say, again, you bought $1 million property and you can depreciate 200,000 over those faster years. You can take that 200,000 as a lump sum deduction this year. Okay. Next year, it's going to go down to 80%. So you're only going to take 80% of that 200,000. Again, 160,000, the remaining 20% can still be depreciated faster over the 5 and 15 year schedules, those faster depreciation schedules, but it cannot be taken all up front. Cheryl asked a great question here. Can you discuss how to calculate if it's worth the $3,000 investment for a single family? So first of all, any amount you're spending on the conservation study is a business expense itself. So it's a deduction, just to point that out. What point or what price point does it really make sense? Typically, I've seen any property purchase for over, $200,000-$300,000 is really where it's going to start to make the most sense. So if you're dealing with smaller properties, dealing with properties that are maybe, much less expensive purchase price, the benefit is going to be much less, because what we're doing is taking a percentage of your purchase price. Again, the depreciation is totally based on your purchase price, and we're taking a percentage of that allows you to take over those faster years. If it's, let's say $100,000 purchase price and we're able to take 20% of that in the first few years, well, again, that's only $20,000. Is it worth it to pay $3,000 to get a $20,000 deduction? Which, again, it's a deduction. It's not cash in your pocket. It's just reducing your taxable income. So the after-tax net benefit is going to be much less depending on what your percentage of tax rate is, et cetera. So typically I like to say anything over 200,000, it's usually worth it at that point. Higher than that, obviously it's pretty much a no-brainer once you get, but yes, it is per property unless you're buying a number of properties together as one. So if you're buying a lump sum, a bunch of properties as a portfolio, and really they're next to each other, or they're kind of all depreciating together on one contract, you can do a conservation study like as a lump group over there. However, if you are just, have a bunch of properties, it needs to be done on every individual thing, because again, we're sending an engineer, we're identifying, the details of every property. It's built different, has a different builder, built in a different year, the structure and everything is going to be really broken down in a totally different way per property. I should touch on one more important thing over here, which is short-term rentals. Does anyone deal with short-term rentals or Airbnbs? I love just putting the chat over there. Say Airbnb is just right, STR or
On
Airbnb.
a regular basis, we have people that does it. So yeah, feel free, please, to touch this subject, because it's interesting anyway.
Yeah, no, it's great. I'd love to, just love to get a little engagement from the listeners as well. So put in the chat there if you guys do deal with Airbnbs. We got at least one person. So Airbnbs or short-term rentals is actually an exception to the rule when it comes to depreciation and the real estate professional status. And this is really something important. I mentioned to you before, and we talked about this a lot, that unfortunately, you're not able to use this depreciation deductions against your W-2 income or your active income. When it comes to short-term rentals, there's an exception to the rule, because the IRS treats short-term rentals as an active business, an active rental. And if the average stay is less than 7 days, and you yourself are self-managing it, so you can't have a property manager, you really have to self-manage it in order to get this benefit. Once you do that, you're able to use those depreciation deductions against your W-2 income as well. Okay, so this is the one exception for short-term rentals. Like I said, we're able to take those depreciation deductions and not only use it against your passive income or your passive gains, but also to use it against your active income as well. Just an important point I thought I'd throw out there, because I know short-term rentals are extremely popular. So Alone asked over, is there a list of components divided by years of depreciation? Yes, there certainly is. There's something called the Conservation Audit Techniques Guide. So you can go to the IRS website, check that out there. Or there's something called what it's based on is, it's called the MACRS. MACRS is spelled MACRS. Okay, that's the modified adjusted cost recovery system. So if you just Google that, you'll see that the IRS has a very detailed list of every single type of property and component within a property that depreciates on a different schedule. Some on a 3, 5. The main categories are 5-year for personal property, non-structural components, and 15-year, that's land improvements, things outside the property. But there are some other categories. Weird things have a 7 or 10-year lifespan. But the main structure of residential property, again, 27.5-year, and then you have, commercial properties on a 39-year schedule. Okay, so great questions here so far, guys. Keep it coming. Keep your questions coming, please. Neer asks, are there different percentages in different states? So I'm not sure what you mean by that, different percentages. What we're talking about cost segregation is on for your federal income tax level. Each state will also have state income tax. Not every state recognizes the 100% bonus depreciation. That's something important to note. But every state, obviously on a federal level, you can take the cost segregation and bonus depreciation.
So should we go into the IRS website to to find out if your state does recognize the 100% depreciation bonus?
Yes, they do have. They should have a list there. But again, that's only on a state level. So you're still going to benefit from the federal level. And every state recognizes cost segregation. So you'll still be able to use the different calculations there. So one thing that we always do, first of all, if anyone's interested, we offer a free analysis, a free consultation, but also like a feasibility analysis. If you have a property and you're like, is this going to make sense? What's the benefit? Is it going to work, or should I just do straight line depreciation? We'll run the numbers and show you the difference with some graphs and charts, just to show you what the difference between using a cost segregation method or just your straight line depreciation method. And that's something we can do. Anyone can contact me to get that. I'll make sure to put my contact information here in at the end. But when we do the full cost segregation study, we also prepare both calculations of the 100% bonus depreciation as well as the regular cost segregation on the 5, 15, 27-year schedules, so that you can apply those based on the respective federal or income or state levels.
So when you do that, you do it in the end of the year, so you can bring it like the 2022 tax year. So basically on somewhere in January or somewhere before you submit all your tax returns for that previous year.
Yeah, you can do this at any time, but yeah, you just need to have it completed before you're going to file your taxes for that year.
So you're going to work directly, whoever like your service is going to work directly with my CPA, or you replacing that one?
No, we don't do any tax filing. We're not an accounting firm, so we're not doing any other CPA or tax work. We're just going to do the cost segregation study. It's going to produce a new depreciation schedule. That one page within this 100-page report is going to be what your accountant needs to plug into your depreciation form on your taxes.
So it's going to be another column in the schedule.
Yeah, they build a roadmap for your CPA to do the depreciation. They don't do the depreciation. They build a roadmap for your CPA to do the depreciation.
Okay, so just adding a column in that schedule, like Schedule A, Schedule B, and that one, in order to file the taxes.
Right. It's literally just taking from what we produce and then just copy and pasting that into your Schedule E on your 1040 or Schedule E line.
Okay. Question.
Perfect. Thank you.
Question, Yonah.
Please.
And again, it's a general for everybody. Do you need to do, because we're talking about the first 5 years, so just so it could be clear for everybody, do we need to do the cost segregation study and study this process when you purchase a property, or can you do it on a property that already owned for a couple of years?
So you can do this at any point. It does not need to be done in the first year of ownership. This can be done retroactively if you've owned a property for a number of years and have just been taking straight line depreciation. You can go back without having to amend your previous year's taxes, because that's always something that's a little bit complicated. You don't want to amend your tax returns. What we'll do is, going forward, do what's called a change of accounting method and allow you to catch up whatever depreciation you could have taken that you missed. And then this year and going forward, you can do the cost segregation method. So yes, it's something most people like to do in the first year just to get it set up the right way. But again, if you've had a property, you didn't know about this, or for whatever reason, you didn't want to do this, you can do this at any time.
So how far can we go back? For example, if I have a property about 10 years ago?
You can go back as far as you want. However, usually like after, depending on the size of the property and the price, the tax basis of the property, it will depend on if you're able to pull out enough depreciation. Because once you've taken depreciation, that's it. It's been taken. All we're doing is taking whatever's left and seeing how much of that we can pull out to faster depreciation. So typically over first 5 years, usually it's can be for most any property, unless it's a very big property, we're dealing with, millions or tens or hundreds of millions of dollars. If you depreciate somewhere for 10 or 20 years, there's so much been taken already. There's not a lot left.
Thank you.
Let's ask a technical question.
Yes.
So let's talk here about okay. Tomorrow I'm a real estate investor, and I'm thinking, I'm not even sure yet, of purchasing a property. And I heard Yonah Weiss talking about cost segregation, something that I'm interested to explore. What happened then? Let's talk about timeline, how things happen. So we'll put it in some kind of an order of things to do when thinking about purchasing a property or doing the cost segregation. When do I call Yonah? What happened then? Exactly how the process itself works.
Yeah, absolutely. So pretty simple process from beginning to end. The first thing we always like to do, like I said, is run a free analysis. You reach out to me, email, you go to our website, you can call me, whatever you want. I don't really pick up the phone so much, but you can definitely reach out. I have an online form, actually, you can just fill out about any property, and it takes us about a day or two to run the numbers and turn around that free analysis. You can look at that, see the numbers. We can have, you can have a discussion, you can speak to your CPA and see if this is something that's going to work out for you. Then once you decide this is something you want to do, it takes us about 6 to 8 weeks from the time you engage our services to complete the full conservation study. We will request, to see a closing statement. If you had an appraisal, site survey done, those are very important as well. And then you have your depreciation schedule, and that's all. You basically have that document. It's a one-time thing that needs to be done per property. And then you have your tax document ready to go, hand it off to your accountant, and they, like I said, just copy and paste those numbers. It's not something that needs to be done before December 31st, before the end of the year, as long as you have it before you file your taxes. So for example, right now we're still doing people who didn't file yet or had filed an extension for 2021, which is due, September 15th was for corporate, and October 15th is coming up in a few weeks for individual returns. We're still working on a lot of those studies right now for 2021. So it's not too late to get it done. However, it is something that you obviously want to make sure that this is going to work for you. So that's why we produce this feasibility analysis, so that you can speak with your accountant. You can see if this is going to work out. If you don't have enough taxable income, it's probably not going to make sense to do.
Is it transferable? If I sell the property, is it transferable to the next owner?
No, it's something that depreciation begins when, based on the new ownership. And so it starts over. So a new owner would, if they wanted to, would need to do a conservation study based on their purchase price and based on, the time that they close on the property.
Got it. Thanks.
Absolutely. So I do see there are a few questions in the chat here, and keep them coming, guys. We do have some more time. So I'll look here. Shalom asked, how about commercial property use as my own office? Yes, you can do this on any business or rental property. And even if you are one of the tenants, as long as you are renting it to others as well, you can use this. So again, if it's, if you're the only tenant in there, but it is run by your business, you can still do cost segregation. And so that's really important. It's treated a little bit differently if you are the only occupant in there. But if it is a business property, you can take cost segregation, you can take depreciation. Even if you are not necessarily a real estate, investor per se. Let's say you just own a factory or you own a warehouse and you're operating your business out of that, or you're a doctor. You may know some people who are doctors or dentists that own their own office where they practice out of. You can also do cost segregation and take depreciation on that as well. Let's see, Corin and Cheryl asked a similar question here. Could you please just share some specific example with the numbers of the deduction process? If you do the costing and then sell within a few years, you're losing out some of the benefit. Both excellent questions. And what's the minimum property purchase price? We mentioned that before. Probably 200,000 a year is the minimum purchase price I would recommend. So to answer Corin's and Cheryl's question, some examples of the numbers. We did go through this before, but I'll just recap. Typically speaking, for single families or multifamily properties, I see that's where the majority of people here are in, but also retail, self-storage, office, it's typically going to be in the range of about 15 to 30% of the property that you can accelerate the depreciation of, meaning we're going to identify components within the property besides for the structure that depreciate on those faster schedules. Typically about 15 to 30% of the property will go into that. So simple numbers, you buy a property for $1 million, you always have to take off a certain amount for land. Land does not depreciate, but whatever's left, let's say we're taking off 10% or 20% for land. Let's say you're left with, just keep it simple, $800,000, $850,000, okay, of your depreciable basis. Of that, about 20% on average or 25% can be depreciated faster. So let's say about $1 million property, on average, about $200,000 of that can be depreciated faster. You mean you could take those tax deductions over a 5 or 15-year period, or you can take it all up front with bonus depreciation in the first year. So that's pretty simple. Again, this is after all is said and done. It's a very detailed process. There will be, a line item of every individual component down to the nails and the doorknobs and everything, and what the value of all those individual components are.
I'm going to try to do something, Yonah, with you, because I think the guys want to see numbers, and let's try to do. And again, we're not going to catch you on the numbers, but let's.
Yeah.
So let's say, for the argument, we have a property. So we depreciate $1 million. We already took the land off, so the building itself is $1 million. On a regular basis, if we depreciate it regularly, it's about $30,000 a year, right? So we get about $30,000. Can we agree on that? Right. If we do an accelerated, and we're going to use a 5-year basis, if we do an accelerate from that $1 million, what we're going to do is we're going to take $200,000, which is going to depreciate over 5 years. So that's $50,000 a year. Plus, we have another $800,000 that's going to appreciate over 27.5 years, which are so that's about $29,000. So now, instead of getting $30,000 a year for the first 5 years, you're going to have about $80,000 in deduction. Is that?
Yeah, that's exactly.
What we do?
That's exactly right. Yeah, that's a great way of breaking it down. And then after the 5 years is up, you will still have the remaining 29 year.
Keep on going down. But the first 5 years, you jump depreciation wise, you jump from 30 to about 80 for the first 5 years. So if you are working with the cash flow, now you have a margin of about $50,000 that you can keep in your pocket in the first 5 years, and you can work with it instead of paying your taxes.
Yeah, exactly. But Charlotte asked a great question. What happens when you sell a property? And this is something really important. Whenever you sell a property, there's something called depreciation recapture tax. Okay, it does not mean that you pay back your depreciation, as I've seen some people talk about in Bigger Pockets and forums like that. It's simply wrong. It does not mean recapture, does not mean you pay back anything. It means that when you sell a property, similar to capital gains tax, if you made a profit, you're going to be taxed on that amount of profit. So too, depreciation recapture tax is whatever amount of depreciation you took during your ownership, you're going to be taxed or subject to a tax on that amount. So it doesn't mean you're paying it back, but it does mean you're going to have this capital gain from the amount of depreciation taken. So if you take more depreciation up front, then you're going to have, if you sell a property, you're going to have a larger tax bill. There are many ways to get around that legally, to defer that further out or to reduce that. However, if you are, as Cheryl asked, if you are planning on selling a property within a year or two, since that benefit is going to be, going to be subject to the tax in a short period of time after that, it's usually not a good idea if you're doing a quick hold to do the cost segregation study, unless you plan to do a 1031 exchange, because that's a way to defer that, or you have other plans to buy other properties and get more benefit from those deductions.
So, Yonah, I have a question about let's say there is any reason why not to take the first year bonus? Why would you not recommend that?
There's really very little reason not to take the 100% bonus depreciation. Pretty much everyone that I've ever worked with has used that 100% bonus, because even if you can't use it this year, those losses will carry forward, meaning you can use them next year and you can use them anytime in the future. So taking those huge deductions can actually be beneficial, not only during this year, for your income, also next year for your income, but also if you have as extra losses when you sell a property, those losses get released and can actually help to reduce your capital gain or that recapture tax as well. So having those extra losses can actually be beneficial, not only in the year of owning it, but also on the sale.
Yeah. So what's gonna happen? Like you said, the next year it's gonna be 80%, 2024 and further.
Yeah. So it's going to, the 100% bonus is going to start going down, phasing out by 20% each year. So there's still going to be cost segregation, but the amount to take up front in the first year is going to start going down.
Unless Trump gonna go get back.
Unless, so everyone contact your local representative. How many people here are actually in the US or are you just in Israel and investing in the US? So I don't know. Everyone just raised their hands, but no one answered the question.
I'm in Colorado.
All right. So you can write in the chat if you want, US or Israel. But no, it's awesome. You guys are in the US and investing in the US as well. Okay. So you guys are taking advantage of the tax code there. Awesome. Colorado, some other rounds in Israel. Like I said, this can be done really from anywhere. But the benefit is really going to be, it does get a little complicated. I'm not going to go into too many details here, but it does get a little complicated if you are in Israel and you're owning in the US to use cost segregation, because unless you use what's called like a blocker entity to set up your company, your LLC with a corporation, then you're going to be double taxed in Israel, meaning Israel is not going to recognize the depreciation. So it does get a little bit complicated there. I would, contact your CPA, make sure that you set it up in the right way so that you're not double taxed there.
Contact your immigration attorney. Find a way to come here.
Yeah, okay, that too. All right.
That's another advice. More question, guys. Okay. Now I
So
have.
after,
Yeah. No, go ahead, Neil.
so when you said after the 5 years, you take that, sorry, you take the bonus depreciation, and then you split the depreciation for the first 5 years. After the 5 years, you still have some kind of depreciation. You still have value, very valid value for the property, land and building. Then what? Do you need to, do you have a different tax level or tax percentage when you pay that?
I mean, I'm not sure what you mean a different level, different tax level.
A tax bracket, sorry.
That is
Well,
not,
yeah.
sorry, your answer.
No, it's actually a really good question. It's one of the hidden benefits of using cost segregation. It can actually lower your tax bracket because
Really?
by having less taxable income, you can actually lower your tax bracket.
Yes, you're right.
Which
Thank you.
which some people can use to get like other vouchers or other type of things because you have a low tax bracket, even though you're making a lot of money. The one thing, another really important thing here is that has anyone ever come across this, that banks, you have trouble getting a loan because of depreciation? Has anyone been challenged with this? I've heard this before, but it shouldn't be that case. I just want to kind of preempt that question because some people, and I've seen this all the time in bigger pockets in these questions, that certain lenders, especially small residential, local banks and things like that, don't understand that you have to add back depreciation. Because again, this is just a deduction. You're actually making that money. You're keeping the cash. But on your tax return, it can show a negative number, right? It doesn't mean that you're actually losing money. It just means that you have a paper loss. You're not paying taxes. So that shouldn't deter you from getting a loan from residential property. However, I have seen a lot of lenders that for some reason are ignorant or just don't understand how to do that. So just thought I'd throw that out there. Any other questions? This has been great. You guys are very active, great questions. And again, I'm going to put my contact info here in the chat. I actually have put my...
I have a question, but it's not a professional question.
Not a professional question. Okay.
Those are the best ones.
No, it's interesting. Yonah, can you share with us how you got to do what you did?
Ever since I was a little kid, I wanted to be a cost segregation expert.
Me too.
That's the truth.
I'm looking for a way to
I'm just kidding. No, it's, everything is, you asked not a professional question. Everything is hashgacha pratit. That's what I see. It's all min hashamayim. I didn't know anything about real estate or, taxes or anything like that probably about 6-7 years ago. I studied in yeshiva and learned in kollel for about 15 years. I'm officially a rabbi or something like that. If you want to call me that, please don't. But I love, once I learned about real estate, I really enjoyed it, loved it. And because I'm a teacher, because I spent many years, teaching and that, it just came naturally to me to be able to learn these concepts and then share it and help other people. So I work for this amazing company, Madison, and that's kind of how it came about. And I just got featured on a lot of podcasts because not a lot of people were talking about this subject. And I figured, hey, this is a space not a lot of people were talking about. I guess I'll start talking about it. And I enjoy it. So that's a little story, little background. And like I said, I've been a guest on about over 300 podcasts. So you can go to my website and you can check out some of those if you want to learn more about the backstory or anything like that, my background. I usually talk about that.
That's I know the story. This is why I asked the question. I actually there was a reason why I asked it. It's an interesting subject by itself, because I do real estate for many years now. I come with a different background, but a lot of people that join us and come to this Zoom coming from a different background. Nobody grow up to be. You don't learn to be real estate investors, and each one have its own story about how you got to it.
Mm-hmm.
And I'm interested in many times in the stories. So that's interesting, and thank you for coming. Any more questions, guys, for ladies, for Yonah?
What's the time frame for doing for that kind of evaluation?
So our free analysis usually takes about a day or two just to turn around. The full conservation study takes us about 6 to 8 weeks to do. So just to have that in mind when you're, planning to file your taxes.
So with between the free estimate versus the full analysis, did you ever had a chance to kind of review, okay, it's going to be a complete 180 results, but the result does not reflect the free analysis. You come to the point and it's like, okay, this is not the case.
No,
we're not going to save you so much, or we save more.
Yeah, never the case. We always project conservatively. And so, like I said, we do about 5,000 of these a year. The actual studies themselves, the analysis, we probably do like 10,000, just people, want to find out and then maybe for whatever reason not do it. But we always project conservatively. So you always know the bare minimum of what you're going to get. There's never been a case where we're coming out and showing when we come down to property, because we're looking at details of the specifics of the property when we do that first analysis.
And when you do the first analysis, did you get to point that it's like, okay, this is not going to be a good saving or whatever it is, we're not going to continue, or?
Sure. Yeah, absolutely.
So what is it, aside from what you deferred about the purchase price, what are the other guidelines that can be deter someone else from not doing it because of a risk of a loss, or just, hire your services and paying you and then find out that it's not? Is there anything that kind of jump out of the page?
Not really. Again, it's the analysis we do is always going to show you upfront what the savings is going to be. So it'll make sense at that point or not. Certain properties are just, kind of too small. If it's, for example, a vacant or totally bare. And yes, we do work in all states. Just to answer Daniel's question there. If you have a property that's vacant or just, kind of bare walls, like a warehouse or something, there's not a lot of personal property in there. There's not going to be a lot to segregate out from that cost. It's just basically going to be structure. And so you can know that ahead of time. And that's probably, like I said, why we do that free analysis. And yes, a loan, it's based totally on the purchase price, not on the appraised value. So even if it does go up in value, unfortunately, that does not change the depreciation.
When you buy a property, usually there is like what is the term for it? A base cost, a base price?
Cost basis is usually what they call it.
Yeah, that's the base. Go up and down, doesn't matter. By the way, go down as well, it doesn't matter. The base is a base, one way or another. Based on your cost, how much you paid for it.
Yeah, exactly. The only time that will change is if you add more money into the property. If you do improvements, any amount that's spent on improvements can be depreciated as well. And so if it's a significant amount, you can actually do a cost segregation on the renovations as well.
Are you guys, working on all states? Every state?
Yeah, we work in all 50 states. And
You
yeah.
personally? No,
What's that?
no, you personally, you're coming to each and every.
No.
I'm joking. But the company it works all over.
Exactly.
So if we intend to renovate a property, it's best to do that after we were done with the renovation, right?
So it depends. It really does, because you can do the cost segregation on the purchase. And so on that purchase price as is, and you can get the tax benefits from the purchase price. However, if you're planning on renovating it before renting it out at all, so really you're not able to depreciate the property before the renovations, because again, it's not been placed in service. It's not been a rental property. So that original purchase price is kind of lost actually. And so you're going to be saying, oh, for example, like if you're replacing all of the furniture, replacing all the, the bathroom vanities and the cabinets and all that kind of stuff, you can't depreciate what you're just disposing of. You can only depreciate what the end product is. So it really does depend. If you're going to rent it out first, then you can do the cost segregation on the purchase. And then at a later point, you can do the cost segregation on the renovations after the fact. Otherwise, you're just going to be looking at it after the renovations, and you're actually going to miss out on some of the benefits from the purchase. That make sense?
Partly. So if I understood it correctly, if I buy, rehab, rent, then I have to do it after the renovation is done. Even though technically I can still do it before the renovation is done. And like I didn't quite get in which scenario I benefit more.
You benefit most if you rent the property out before you do the renovations, because you can take the cost segregation on your purchase price. Let's say you buy property for, $1 million, let's say, and you can take those $200,000 deductions. And then at a later point, you spend $100,000 on renovating it. That $100,000 you can now depreciate as well. And a large percentage of that you can take as bonus depreciation, as a tax write-off. However, if you didn't rent it out at all, you can only do the cost segregation once you finished the renovations, once it's been rented out. And at that point, you actually lose out the cost segregation from the purchase, because a lot of those components you've gotten rid of, you've disposed of. So you can't depreciate what you've already disposed of. You can only depreciate what the property is at that point.
Got it. Thank you.
All right. One last question here. It looks like I do have to run. So if you do have other follow-up questions, I put my link tree over the ways to many ways to contact me. Make sure to copy that. And Shalom asked a question here. What about when ownerships change not through sale between family members or non-passive entities owned by same owner, depreciation lifespan reset? It does not. When it's a non-arm's length transaction like that, depreciation does not reset. However, if it's done through a inheritance, then it does reset. It's called a step up in basis. So that's different than passing from one entity to another. But if you actually inherit a property, now your depreciation is going to be based on what's called a step up in basis, based on the new fair market value of the property.
Understood.
All righty.
Okay.
Well, guys, make sure to follow me on LinkedIn. That's where I'm most active. I'm also on all the other platforms as well. But great to be here, Tal. I appreciate you having me. And this has been a great group. You guys are very intelligent questions. And it's been wonderful spending the time with you.
Yonah, thank you very much for your time. I really appreciate it. I know you're busy and you need to run. Thank you very much. Really helpful and eye-opening. Thank you.
It's been
Thank
my
you very
pleasure.
much.
Thank you.
Thank you, guys. Thank you, ladies. Have a great evening.
Okay. Thanks.
Thank you.
Bye, Yonah. Thank you.
Happy Rosh Hashanah.
And Shana Tova to everyone.
Shana Tova. Shana Tova.